I've been encouraging people to get involved with crypto, kind of gently. I think of it as like encouraging someone to learn how to ride a bicycle, where you know that it's definitely more dangerous than not riding a bicycle. And there's probably going to be some falls and some scraped knees and stuff. But overall, you should probably learn how to ride a bicycle. You guys have both gotten involved in the past months, and we've been talking about the various kind of struggles one faces as an early adopter of crypto. And just one of those situations where I feel like we should talk about this publicly. We might as well, because certainly, we're not the only ones having the same questions, going through the same things, and so on. And I think that it's, first of all, we have a episode which is how to not go broke in the Bitcoin boom, and that's still the first source of truth that I would send people to, right? Because the important insight here is that if you just follow your emotions, you'll probably just lose money. I still think you should probably do it, right? It's just that I think being exposed to the crypto market is overall better than not being exposed to it. But depending on how reckless and how risk unaware someone is, you can do some real damage to yourself if you just follow your emotional impulses, right? And that's what that episode is about. So that's, I think, is a good starting point. And also, we have a whole course about how to make money, or how to build wealth rather, which is free, which is also like for anyone who actually is serious about this and would like to be rich in like 10 years or so. That's, again, it's a source of truth. All you have to do is spend time to watch it. And we are not talking about, none of the stuff I want to talk about is price related, right? Because obviously that's the exciting part, right? Price goes up, everyone's happy. Price goes down, everyone's sad, etc. And but that's like not the, like that. I feel like that doesn't require any further elaboration. Everybody notices that. Oh, price goes up, awesome. So I basically want to talk about everything else. So let's start with one of the questions is like, one of the problems is that how do you actually benefit from this beyond the number go up factor? So, because obviously you can use an exchange, right? You can use an exchange app like, I don't know, FTX or Gemini or whatever, and you buy some Bitcoin, and then you have some Bitcoin. You don't really have it, right? But they owe it to you. The exchange owes you some Bitcoin, and the value of that Bitcoin hopefully goes up, and then you're happy, right? But there's all this other stuff going on. There is the whole decentralized finance area. There are stable coins. There are opportunities to earn yield, and all this other stuff. But one problem there is like the onboarding problem, right? Like, how do you actually get involved? Because, like, okay, in theory, you can have, your US dollar stable coins. You can have your USDC or USDT or there's like 15 others. And you can earn like, I don't know, 4%, 7%, 10%, depending on how degen you go. You can earn like, dozens of percent of annual yield on it. And that sounds good, but how do you actually do it, right? How do you actually get in? And you were struggling with this recently, right?
Yeah. That was actually precisely the situation, right? So when I went through the wealth course again, there were like those platforms that you suggested, like Nexo and Celsius, and so was another one. I think Coinbase also had like this option where you basically can put your crypto in and earn like 4%, 8%, 10%. Obviously, this annually, and there was like especially companies like Nexo and I think Celsius as well had like insurances on their stuff, and it felt somewhat safe. Obviously, those companies, right? Like they, I just remember that like one of them had like I think 13 billion worth in assets and then a 375 million insurance. So obviously, shit can go wrong. So,
yeah.
Right? But like what my thinking was, okay, I'll just get some stable coin. I'll earn 10% on it, roughly, like Next and Celsius suggested, and a little bit less on Coinbase, and basically like go into each one of these platforms. And this way I'll diversify my risk. Basically, when one of them goes bust, I still have the others.
Mm-hmm.
And I was basically thinking of putting my runway into it, right? Like the money that I basically want to lock away, so that it's not just simply idling, but and like eroding away by inflation. But
and just as a quick definition, right? So your runway money would be essentially the money that you can live off of in case you lose all sources of income, right? And we call it a runway because you have a 6-month runway. If today you lose all sources of income and you can just live off of that cash for 6 months, that would be a 6-month runway. So that's what we're talking about.
Exactly. So right now I just have that in my account, and it's not doing anything. So then we looked into it, like looked into how to actually get stablecoin on there, and that then became like really like complicated. And the onboarding process, or the basically getting the stablecoin and then also getting it on the platform, seemed to be really difficult. So it was really easy to get an account, but then you need to verify your profile. You need to get a wallet. You need to get a wallet where you can get that. And then I got a wallet and wanted to buy stablecoin, and then damn, 43 euros. Like I basically wanted to make like a start transaction just to feel it out, which was like minimum $100 or so. So I wanted to put it in, and then it was like, you get 100 in stablecoin, you pay 150 in dollars. And I'm like, what? And basically looked into where this money was going, and it was like $43 networking fee. Mm-hmm. It's like I'm getting 10% on that, even if it's compounding.
You'll never make it back, right? You'll never make on a $100 transfer. You'll never make your network fee back. Yeah. And so this is something just like, and this is something where you can ask questions if something isn't clear, right? But basically, if you're seeing a $50 network fee, you're probably operating on Ethereum layer 1, which means like the base layer of Ethereum directly on the Ethereum network. And the Ethereum network makes a trade-off between essentially decentralization and fees. So the idea is that for the network to be truly decentralized, you want to make sure that anyone can run a node of the network at home. And that means it can't require massive hardware, right? So if you say, okay, in order to run your own node of a network, you need to invest like $150,000 into high-tech server hardware, then it's not going to be very decentralized, right? Because very few actors can afford this kind of money. And so with Ethereum, the idea is that you can, I don't know what it would cost. The minimum would probably be maybe something like $500 to run your own node that validates the Ethereum network. And because the costs are so low, it is the most decentralized network of its kind with, I think it's something like tens of thousands of nodes running. And this is a good thing, right? This is a good thing for the decentralization, the security of the network. But because the hardware of each individual node is relatively weak, it means that there is a limit. There's essentially a throughput limit, right? And because again, if you think about it, right, the network itself is all of those computers running the network. And because those are relatively affordable computers, the amount of data you can push through the network at any given moment is relatively low. And because there's huge demand for the network, the result of that is high fees. Because essentially you can say, look, there's only this much, it's called block space, right? There's like only this much space for every block. And you have to bid if you want to be in this block. And it just creates a bidding war, right? If there's more people who want to be in than there's space available, then it's just like, well, I'm going to outbid whoever is the lowest bidder so that I get in this block. And so with Ethereum, this is happening all the time. And because there's so much demand for it, honestly, $40 is pretty cheap these days. Okay, it's not uncommon especially if you have like, if a simple transfer, like sending a token from one wallet to another, that's going to cost like $50 to $100 or so. Typically in the last few weeks, more complex interactions with contracts, easily $100, $200 or more, right? For a single, just like get my money into this contract, it's like $200. And so this creates exactly that problem. Like, even if you have a contract, you're interacting with some DeFi, some decentralized finance application where, okay, you can earn yield here. But it's like, if it costs $200 to get your money in and then presumably $200 to get it out again, it's like you have to transact in hundreds of thousands of dollars, because otherwise you're just never going to make that money back, right? And so this is a serious problem. And it's a problem. This is where this is an early adopter problem, because there are technical solutions to this, and it's called layer 2, essentially. So you have, it's almost like separate networks that settle onto the Ethereum network. And you have these layer 2 solutions. Some of them are really good. Arbitrum is one I've used, which I think is really good. I'm very excited about the zero knowledge ones coming out. But again, the onboarding process is, okay, well, how do I get my money into Arbitrum? Well, usually you have to buy Ethereum, put it in an Ethereum wallet, then bridge it to Arbitrum. Again, you've already spent like $300 just to do that, right? Yeah. So you have to spend $300 in order to be able to cheaply transact, right? That's like, it really prices people out horribly, and this is a serious issue. Like, personally, like I've told you, like I'm at the same time a huge fan of Ethereum. I love Ethereum as the principles behind it. I love that the trade-offs they make. I think they're making the right trade-offs. I think it might be the future of everything, but I also hate it. I fucking hate Ethereum. Like, the user experience of layer 1 Ethereum is the absolute worst. I fucking hate it. And it's just like, and I feel like it cannot be said loudly enough, because there's so many, Ethereum fanboys basically, who they basically just can't admit that it's a piece of shit, right? It's a piece of shit. Like, who the fuck wants to use an application where, essentially, imagine using a phone app where every time you tap an icon, it costs $100 and you have to wait for half an hour. Like, how is that good? In no version of the universe is that a good idea, right? And we just have to admit, unless you're settling millions of dollars, it's a piece of shit. And even if you're settling millions of dollars, like, who the fuck wants to, like, even then I would like to have a cheaper, faster network, please, right? So anyway, I think that it has to be said, right? This is terrible and it needs to change. And even some of the L2s and some of the, the alternative chains and whatnot that are, better and faster and whatnot, that make different trade-offs, even many of them are too expensive. I mean, even Arbitrum transactions right now are too expensive, let's be honest. But anyway, the problem is basically, and this is the on-ramp, off-ramp problem, is that it is too inconvenient to get your money, to get your fiat money onto these networks and off of the networks. Because, and I would really like to be, I would like to be a more integrated user of this stuff. So, for example, I would prefer to have basically all my money in crypto. Like, I would like to have all my money on chain. I'm not a huge fan of banks. I've had a horrible experience with banks. I would rather have all my money on chain, and I would like to pay everyone in crypto. I would like to be able to do that kind of stuff. But there's another, the other side of that problem is, of course, I could pay you guys in stable coins, for example, right? But then, how do you spend those stable coins? There's a lack of off-ramping as well. Like, we need to get to the state. The ideal outcome would be, that you just have a card, right, or a phone app that you use to make payments at your, a point of sale payment terminals. By the typical, tap the card or tap the phone, right? But instead of it going through the Visa network, through your bank, all this, like, there's so many steps involved in that. It's kind of dumb, right? It would basically be a crypto transaction. So, and that would be ideal, right? The ideal. So that shows you how early we are, because ideally, I would like our customers to pay us in crypto. I would like to hold the company's money in crypto, pay everyone that we need to pay in crypto, and every one of them can go around and pay for whatever they want in crypto, right? But the reality is, right now, you have to on-ramp your money and you have to off-ramp your money. And if it's expensive, that makes it kind of pointless, right? Especially if you just want to earn yield on stablecoins, unless you're moving around huge amounts of money, it makes it kind of pointless. And if it's inconvenient, that also doesn't help. Because you could use something like Solana, right? Solana is essentially like the non-decentralized version of Ethereum. And also, I've pissed off all the Ethereum fanboys afterward. I've just pissed off all the Solana fanboys by saying that. But let's be honest, it's not decentralized. It went offline for like 17 hours a few weeks ago. It's like, look, your blockchain is not supposed to go offline. That's not supposed to happen. All right. Yeah. So Solana is on the other side, where it's like, it's very fast, it's very cheap, it's really nice to use, right? And it's the kind of thing where each transaction costs some fraction of a cent. It costs so little that you don't even care. It's very fast, super nice to use, right? So from a user experience perspective, I would immediately say, okay, yes, let's use Solana. But then from a security perspective, you're suddenly like, okay, you start worrying more about having a lot of money there, right? But again, then how do you spend your money, right? If I send you Solana stable coins as your salary, what you do, like, then you have to figure out, you have to send it to it, you probably have to like exchange it for the Solana token, send it to a centralized exchange, change it to euros there, pay it to your bank. It's like the process is horrible, basically.
Like for me to understand, the networking fee remains the same for every transaction?
No, it's the network fee. It kind of depends on how much block space it uses up, essentially. So it's like how many steps are in this, or how much data does it take up. But you can think of it as like block space, right? Literally, the blockchain, right, saves one block after another onto the chain, and there's a certain amount of space in each block. And depending on how much of that space you want to use up, depending on how much data you want to use, the more you have to pay.
And is that data used up mainly by me doing the transaction itself, or is it mainly used up by how much of the assets I transfer?
Oh no, it doesn't matter how much you transfer.
Okay,
so the transfer fee, it's not like a percentage, right?
Okay.
Because, and you can think of it, right? If the thing you want to write to the chain is, send this amount of tokens to this contract. That basically uses the same amount of data, whether the amount you send is 100 or 1,000 or 10,000 or 1,000,000. It doesn't use significantly more data.
Yeah.
So, yeah.
So what I was thinking is, maybe as an early adopter option, while this is all a little bit shitty, right? If we're talking about, for example, the company holding a little bit of or not even Bitcoin, like crypto, just crypto. And also paying people in crypto, and maybe it's an early adopter option to basically on a monthly basis or so on ramp with a one-time fee, basically a part of the company's money based on how much we want to deposit, and how people, maybe we can split pay people or so. I don't know how significantly more elaborate that would be, but maybe that might be a way to basically get around most of the on-ramping costs.
Yeah. I mean, this is really the problem with especially Ethereum layer 1, is that it's so expensive that even for something like your monthly salary, it's not worth doing. But the impact it has on that price every month, it's just too much. Especially if you have to pay it twice, because you have to pay it to get it on and to get it off, right?
Well, I would imagine that when you pay salary in on-ramped crypto, that you'd probably, like, you would have like a percent. Like, for example, if we make a deal, let's say it's just a fictional number, the payout is 2K or so, right? That we then say, okay, can I be paid 1.5 in euro and 500 in stablecoin, because then I can use the stablecoin and just get it directly onto Nexo and just don't do anything with it, but it's just there.
Yeah, I mean, I think there are definitely options to explore, but I think even for something like this, I wouldn't want to be on layer 1.
Yeah.
Because I would like, I think Ethereum is the best bet for a smart contract platform. But I think what we really need is really good integration and on and off ramping from and to a layer 2 directly. So what would work, and I think there's like first signs of this happening, But I don't know if there's any working implementations right now. But what would work is if I can exchange dollars or euros or something for Ethereum, let's say, on a centralized exchange, because that's generally the on-ramp right now, right? You have to have something like that. And then I send it directly to Arbitrum. So I basically never interact with layer 1 at all. That solves the problem, right? And then you can then you can say, okay, I'll pay you the salary, and there the fee, the transaction fee, I think currently would be something like $1 or $2 or something per transaction. So it's like, it's not a problem, right? It's still too expensive. It's supposed to be cheap, but that doesn't have like this tangible impact on the bottom line anymore, you know?
Yeah.
But yeah, as far as I know, you know, you can have direct paths like that to some of these side chain type things. I mean, you can definitely do it to like Binance Smart Chain, but that's like the least centralized thing of all time. And or the least decentralized thing, I should say, of all time. And Polygon, which is kind of also not quite the real thing. Like the ones I would really, you know, the ones that I feel like, okay, technologically, this is the right thing to use, are kind of still coming. They're kind of still coming. And I do think they will come, but it's just an interesting moment, because I think you can see that as a speculator or investor to crypto, we're not that early anymore. But as an actual user, you're still pretty early, right? Because the majority of the use case of crypto up until this point has been to make more money.
A question I have on that is, it's clear to be an early adopter of making more money. It's going to be good for you. If you bought a little bit earlier, you're going to be rich now. But with sort of, what's the benefit of being an early adopter of a user? Or is there one?
I mean, I think that's the problem, right? Right now, there's not really a strong benefit for this. It is, so if I think about it from my perspective, if we think about the company's money, one of the benefits of having the company's money on chain would be that we could earn some yield while doing other things. And essentially, and the larger your company treasury is, the more interesting that becomes. So, because also the impact of just inflation just becomes more and more painful and more meaningful the more money you're working with, essentially. And there, yeah, I'd be very interested. To me, that would be a serious benefit, right? If we could have, again, if we could get paid in crypto, essentially, so it's on chain right away, and we could basically deploy our capital more intelligently, right? We could deploy our capital more intelligently and with fewer loopholes to jump through, which basically would just make the whole operation more efficient. So, because my take here would be, I would like to take on a little bit of risk in order to increase our chances of just multiplying our money. And so if we could do everything on chain, and we could say, okay, look, all the money, you know, and also this kind of automation potential where you can say, look, all the money comes in, it's on chain, it automatically gets directed to some kind of an allocation that we decide, right? Here's how we allocate our capital into like higher and lower risk baskets. And this earns money the entire time. And then you either have once a month payouts to everyone who needs to get paid, or you could even have streaming payments, which I think would be fucking cool. I think that makes a lot of sense, right? Where you have essentially, instead of paying people in batch once a month, if you could just stream payments, and you could have the whole thing essentially as a flow. Like imagine if you have, and I think that's one of the potential futures, you know, that we could arrive at, is that your customers pay you by streaming money. So especially for recurring stuff, you know, instead of once a month, you know, it's like this many fractions of a cent every minute or something. So your customers stream this money to you, you allocate it into however you want to allocate it, and it streams out to the people who need to get paid. This could be massively more efficient But again, it only works if the fees are very, very low.
Yeah.
So, and there, but I'd be fine with either, because the, monthly payment thing also has an advantage where you can essentially hold on to the money for a whole month and let it grow and then pay people. So that's also fine. But yeah, I think right now, my perspective on the whole market is that the potential benefits are still like very early and very, many are unproven, and you're taking on a lot of risk just because stuff can go wrong. And the drawbacks are basically a huge obstacle. I mean, this is why we're not doing it yet. Otherwise we'd be all over this. Yeah.
So when I'm thinking, like, let's say we're selling a product, right? And it's worth it's like a more high ticket product, right? The fees would be so high that they would like if we for example give customers two options where we say, okay, let's say if you pay us in, let's say, Bitcoin or stablecoin or whatever we want them to pay us in another currency, that we give them the option and maybe have them pay a little bit less because we know that we are getting it back in our yields, right?
Yeah.
And do you think that the transaction cost is so high that most people are going to be like, sorry, but no? Or do you just think that most people are not using it yet, so that they're like...
both. So yeah, if you basically, if you wanted to switch the business to pay me in crypto, unless you are basically exclusively doing all your marketing and community building and so on in the crypto space, for most people it'd just be like, I can't do this. I can't pay you with this. But also, yeah, Ethereum is untenable for this, because yeah, if you say, even if the product is expensive, even if it's a $2,000 product, and then you pay a $100 fee or $200, it's basically too much. It's too much of an addition. And of course, the way you would do it is that you would take the network, like we would pay the network fee. But again, then it's like, it just doesn't make sense, right? You're just giving money away for a very limited benefit. So again, like I think definitely different solutions have to emerge here. And even for things like subscription payments, there's just no decent system for this yet in the crypto space, because in the fiat space, you have you have all these systems with credit and debit cards and all this kind of stuff that allow someone to take subscription payments and be fairly sure that next month you're going to get paid again. And in crypto, that doesn't really exist yet.
Yeah, and Bitcoin, what a on-ramping process is not really a problem. Like that payment would be too volatile to be like, pay us this much in Bitcoin, or...
Yeah, I mean that's also an interesting problem, that all the most popular cryptocurrencies share this problem, is that like the reason people get in is because number go up, and therefore you don't want to spend it. Like, who wants to spend their Bitcoin, right? And you even have Michael Saylor, I think this is a real quote. I don't know, with that guy you don't know. So Michael Saylor is the MicroStrategy CEO who has become notorious for basically buying as much Bitcoin as he possibly can with his company's balance sheet. And yeah, he's like the Bitcoin Chad, right? And he's very vocal about it. And so yeah, I'm not entirely sure if this is a real quote, but let's assume it's a real quote. A Michael Saylor quote is like, the first rule of Bitcoin is you do not sell your Bitcoin. The second rule of Bitcoin is you do not sell your Bitcoin. And it makes sense, right? If you're a believer, if you are buying this, especially if you're like a more... that's the interesting thing about Bitcoin, actually, because Bitcoin has become, it's like the boomer crypto now, right? Because you're not buying Bitcoin anymore because you're hoping to become a millionaire next month. It's too late for that with Bitcoin. And that's why everybody, that's why people that's why people buy Cardano, right? Because Cardano is cheaper. And all the other stuff, right? Doge, Shiba, you name it. All the other cheap coins that people love to buy. One of the greatest value proposition memes in the entire space is if this goes to $1, I'll have X dollars, right? So you have Shiba Inu, which costs $0.0000001. You go, oh my God, if I buy 10 million of these, if it goes to $1, I'll have $10 million. Never mind whether that's even remotely possible, right? That's just a very strong value proposition, right? And so, so people are aping into all this stuff because they're hoping to become rich very, very soon. But Bitcoin is already not like that anymore. Like, I think everybody knows that if you buy Bitcoin now, it's more like you'll be rich in 10 years kind of thing, right? So, which means you either have traders who know what they're doing, or you have high conviction holders, where the two rules that I just outlined before do apply. Like, why would you buy the thing that's literally going to make you financially free in 5 to 10 years? Why would you sell the thing? Yeah, why would you sell the thing that is going to make you financially free in 10 years? That makes no sense. And so if someone offers a course or some other product, and you can either pay in Bitcoin, which is going to make you rich in the future, or in fiat, which is dropping in value as we speak, obviously you're going to pay in fiat. And this is also a big, in terms of like economic theory, this is a big thing about inflationary money, right? This is your local politician is about to remind you that inflation is a good thing. They haven't talked about this in a long time, but now they're going to start bringing it up. They're going to say, you know what? Inflation is a good thing because it stimulates the economy, because it makes people spend, right? If you have deflationary currency, so it becomes more valuable over time, you don't want to spend it. You want to hold on to it. And that's bad for the economy because the economy needs money to circulate, right? And inflation is good because it makes people spend money. And this is also, and by the way, right, in the EU, we have people experiencing negative interest rates on their bank accounts. This is a real thing.
Yeah, I had a bank account that had like that. I had basically no money on it, but every time it like zapped me a couple of cents every month or so.
Yeah.
I was like,
yeah.
Why?
Yes, negative interest rates, because inflation isn't bad enough. Apparently, it's not bad enough that your money is losing value. You're also getting punished for holding it at all, right? And yeah, this is all to stimulate the economy. Anyway, so this is definitely a problem, right? If you're holding something, and this is also the whole meme, the narrative, or one of the more successful narratives in this cycle for Bitcoin has been, store of value. It's a long-term store of value. It's the thing that you put your money in order to preserve and grow value. And you generally don't transact with your store of value. And so I think this is, again, the goal outcome here would be that that it's basically just easier to make these decisions. Because, yeah, even if you say, okay, I want to get paid in Bitcoin, you're still going to make a decision about how much of that am I going to convert into spending money, right? And, yeah, I mean, I think the smart thing to do is it basically doesn't matter if you get paid in Bitcoin and then convert some of it into fiat or stable coins. Basically, you convert some of it into spending money. Or it's the other way around. You get paid in fiat and you convert some of it in Bitcoin. Because you definitely don't, like, one of the reasons it doesn't make sense to simply only get paid in Bitcoin and spend Bitcoin is because it could be problematic if Bitcoin crashes. It's like, oh, suddenly I just don't have enough money to pay rent, right? Because just my net worth was cut in half. And that is still in the cards, right? Like, Bitcoin is getting a bit less volatile, but it's only been a few months since the last 55% drawdown in 1 week, right? So it's still, if you just have all your money in Bitcoin, yeah, you can still see your net worth cut in half in very short order. And so, yeah, it makes more sense to have a pool of spending money and you have investing money. And if you're a Bitcoin maxi, then you want as much money as possible in Bitcoin. But I think for most people, it makes sense to have some kind of a mix of assets. You have your spending money, maybe you have some yield-bearing asset or something where you don't expect, the price to spike like crazy, but you kind of expect a more gradual increase, and then you have some more risky assets. And the goal is really to make that as easy as possible, right? That's where we want to get to, where you can like decide what is my allocation, where do I want my money to go, and whenever you get paid, it automatically distributes into these categories, right?
I maybe want to quickly talk about Revolut, the online bank that I'm using, has this very nice feature where they basically have a crypto tab, which doesn't mean that you have a wallet technically. It just means that the company owes you that Bitcoin, but it makes it very convenient to basically just, you open the app, you click on crypto, you tap buy, and off you go.
Yeah.
Right. And I found that to be, that more than anything else, a catalyst for basically getting into it, because like once you're invested, as you said, like now I'm checking the course every second day or something, and obviously it's on my mind because of that. And now I'm starting to think about like getting a decentralized like non-custodian like wallet and shit like that.
Yeah, and it's I also think that in past years, in past cycles, there was a lot of talk about not your keys, not your coins, right? If you don't actually have self-custody of the private keys, then it's not your Bitcoin and you're going to lose it and everything's going to be terrible. And that's because, of course, some people were burnt, right? The Mt. Gox thing, if anyone wants to read up on that, right? Lots of people lost lots and lots of money in the Mt. Gox crash, basically. And so there was a lot of the chanting of, always take your coins off of the exchanges because you could lose it all. I think that's just not true anymore, basically. I don't think that's a huge risk to have some money on Revolut or on your Coinbase account or whatever. And it's the same kind of thinking, like a good hardware wallet will cost, I don't know, anything between like 100 and maybe 300 euros or dollars, something like that, right? So basically, it's not cheap. And obviously, right, it's the thing that secures your wealth. You wouldn't want to get the cheapest one. You want to get the most secure one. So you're going to be spending over $100, let's say. And that just doesn't make sense to do if you own $100 worth of Bitcoin. It makes sense to do once you own a significant amount, once you own maybe a few $1,000s worth of it. Like then you should start thinking about, okay, I should have a hardware wallet and I should move this to a hardware wallet, right? That makes sense. But I think we are now in the position where, obviously, look, I think that it would be much better to not need centralized institutions like Revolut to do this. But realistically, that's how you start, right? You start with the simplest option. And I think Revolut have done a good job of that to make it easy to just get in. And then as you get into it and as your assets grow, you need to start thinking about other options.
Yeah, I mean, that's been my experience using Bitstamp. And to go all the way back to the beginning where you said kind of like slowly getting into this type of thing, it was a real easy way. I followed the rule, like only put 50 euros in. And then you learn all those little lessons along that way of going, oh, this is how that works. And oh, this is how you think you know it until that it happens, right? And then you put a bit of money in, willing to lose it, it grows. And then over time you learn and off you go. So I've also been really happy with that process, and also just like that, building that emotional resilience as you go in the beginning. It's really important. But now, listening to these conversations and also learning what these conversations even mean was important. And that took 3 months. And some of the points I'm still a bit behind on some of the stuff, and like, okay. But what I'm getting at here is I really do see how this is different to the stock market. It's that accessibility that we already have now. Yes, it's not as good as it should be, but it's already a whole lot easier and a whole lot more accessible.
Yeah.
And that makes it both more dangerous, but also great, because everyday people like myself are starting to understand how to make money from money and not from the work that we do.
Yeah.
And that's what I can see as like why this is important, because I think that even small time entrepreneurs will have that potential in the future where they can do whatever they want to do because they love it and they're good at it. And the way that their business is set up, their business model is based on money makes money, not on I'm selling my time. And this, for me, if I'm understanding this correctly, that's where we're going with this, if it works out.
Yeah, I mean, I think that's also something that will become less and less the case. And in that sense, we are still early, right? Because we are still and obviously, look, I could be wrong about all this, right? But I happen to think that that crypto and Web3 kind of stuff, which is, you know, all this decentralized finance, NFTs and so on, is often referred to as Web3 now. I happen to think that this is going to be a very significant part of the future. I happen to think that what we are looking at here is the early stages of something that will transform society, just like, you know, the iPhone in 2007, just like the rise of social media, right? Where in the beginning this wasn't clear. In the beginning it wasn't clear that some website where university students can find other university students would become like a major influence on everyone's life. That wasn't clear. I think that this is what we're looking at. And I do think in that sense we are still early, which is also why I say, look, I think it is positive expected value. I think it is just being exposed to crypto, even if you make mistakes and you lose money and stuff like that. As long as you don't exit the game, I think you're going to look back on this and be like, oh, thank God. Thank God I got in then, you know. Because I do think that if it takes over the world, it will be less the case that you can just be like, oh, I'm just going to put my money here and I'll eventually get rich, right? Like, you know, the Bitcoin price appreciation will flatten out, and the edge you can have by going out in the risk curve and buying doggy coins and stuff like that it's also going to get harder to win doing that. So I do think that maybe for the next, let's say, decade or so, that is a huge opportunity where you can put some of your money into crypto, and it's going to accelerate your path towards financial freedom. But I don't think it's a long-term like sustainable use case. Although I do think like one of the things that this will do, if it succeeds, is it will capture all the inefficiency that's currently being captured by middlemen. So right now, like the reason that you put your money in a bank account and you're losing it. You're losing it to fees, you're losing it to inflation, you're losing it to interest rates that are either non-existent or even negative. But meanwhile, there's this whole machinery of banks and hedge funds and trust fund managers and investors and all this huge machinery that's extracting loads of money out of this system. So it's like they're getting all the money instead of you getting that money. And so I do think that in a normal world, it should be possible to have an economy where people are paid a living wage, a thriving wage perhaps, and where you can have a savings that grows at some reasonable rate. You know, it's not going to be 100% a year on average, like Bitcoin has been doing, but it's going to be maybe 3% or 4% or 5% or something per year. You know, and that's actually really significant. that matters over a lifetime. That matters a lot, right? So I do think that that's going to become more normal. Yeah.
I also wanted to just like piggyback on a comment on like basically entrepreneurs changing their business model a bit to basically holding more of their value somewhere else. Like I know a few people, especially coaches, who have basically been like, I wanna like make an online course or so to become like to basically detach like my time that I spend on a daily basis from my income and stuff. And I was thinking that might be a valuable a viable option, at least at the moment, to basically like do the coaching and do the thing that is basically giving you a significant amount of money, and basically just like always keeping 20 or 30% into something that is somewhat well appreciating. At some point you can probably extract so much from it that you can say, okay, let's just take a month off or a month or 2 months off, or let's just like use those 2 months off to create that product, which is then gonna help me make more passive income, right?
Totally. And I mean, even more so, right? I think that this is a way to accelerate towards financial freedom, is if you take on this bet, right? If you say, okay, this is going to grow, like the whole space. This is something, Raoul Pal, who is a macroeconomics guy, he basically, this is a quote from him, is he's just like, look, this whole space is going to go 100x, right? It doesn't mean that every single crappy coin is going to go 100x, but like the space as a whole is going to grow by 100x. So if you have reasonable exposure to it, then you're going to see very, very serious appreciation. And that means that one of the ways in which to accelerate towards financial freedom, and that's what I would do if I were starting out now, is to go really hard now and plow as much money as possible into this.
While you're saying that like the space has a lot of potential, is there something that equals like the World Index Fund for like what is the largest scale basically thing that covers the whole market, or does something like that exist?
There are indexes that you can get into. So there is like it's like the top 20, the crypto 20, some allocation of top 20 coins. There's the BED index, which is Bitcoin, Ethereum, and DeFi. What is it? The DeFi perp? No, the DeFi crap. The DPI. I can't remember what DPI stands for, but anyway, that is an index of decentralized finance tokens, and there's a bunch of others. In general, these indexes haven't performed great compared to individual assets. So, for example, the DPI has underperformed pretty horribly for quite a long time because it consists of like the original DeFi tokens like Aave, Uniswap, Maker, and whatnot. And these have underperformed horribly compared to Ethereum and compared to newer DeFi projects like Olympus DAO and whatnot. And even like something like the Crypto 20 index, I think has basically just underperformed, because if you look at the top 20 from 5 years ago or so when that index was started, like most of those coins are not in the top 20 anymore. They're nowhere near the top 20. And so that means that there's a constant rebalancing into all these new coins that come into the top 20. And if you just had held Ethereum, we would have outperformed it by miles. So right now, there isn't an index with a proven track record that has been a really good bet for a long time. For the most part, basically hold Bitcoin. There's like this. It's crazy to say that, but that's like the safe option. Hold Bitcoin. Only goes down by like 70% or so. Right? and if you're more hardcore, it's like Ethereum, right? Ethereum went down by something 95%, I think, last cycle. It went down really, really brutally. And it outperformed a lot of the market, even though it's basically been the number 2 coin almost the entire time. And then there's, of course, people who bought Doge made a lot of money if they sold at the right time. People who bought Shiba made insane amounts of money if they sold at the right time. People who bought Solana early on, congratulations, well done. We don't have the if they sold at the right time moment yet, but who knows, right? But yeah, it's like basically. And this is why I generally tell people just buy Bitcoin and Ethereum and nothing else. Because first of all, I know that you're going to buy other stuff anyway. It's not like I'm going to stop you from doing that, right? But it's just like
I'm proud to say I haven't.
You haven't bought anything else yet.
I had XRP for like a couple of days and then I got rid of it.
Mm-hmm.
Actually, because I didn't know better. This is part of that learning curve. I didn't understand that like each coin and each thing has its own environment. Like that's how green I was.
Mm-hmm.
Once you gave me sort of a hint of like, no, there's this thing in the court case. And I was like, what? Research this. get rid of it, bought Ethereum, been happy ever since.
Yeah. It's not a bad bet. Yeah, so let's briefly also talk about that, right? There's, because I've hinted at this, but I don't think we've talked about it. It's basically unit bias, right? And this is an interesting effect where essentially newbies who get into crypto will always become interested in Cardano and XRP, and often also Doge and other coins like that, because they're quote unquote cheap. So you look at Bitcoin and you go, oh my God, this is like $50,000 or $60,000 or $100,000, whatever, right? Whatever it is right now. You never know. Anyway, it's around, it's 60 something thousand as we're recording this. And you look at that and you go, wow, that's expensive. I can't even afford a whole one of those for most people, right? You can't put that much money in. So, and everyone's, people are telling me about Bitcoin and whatnot, but it's like you go down the list of tokens you can buy. And you see Cardano, ADA, the ticker is ADA, and you go, oh, this is like, I don't know what it is now, like $2 or something. But for a long time, it was, under $1. So like, oh, this is cheap.
Yeah, I did that. XRP, I had $100. I bought 100 units. I was like,
there you go,
and
right?
I was like,
oh my God.
And I did that whole calculation.
Exactly.
If there's 100 X's, I'm like, here we
and
go.
even more so, you see something like Cardano, you see XRP, and it's like, oh, this is under $1, or it's only a few dollars. Like I can own hundreds of these,
become a millionaire.
And what if this becomes as expensive as Bitcoin? I'll be so rich. So first of all, why doesn't that work? It doesn't work because you have to look at the total market cap, and basically you can't just say, well, this coin could be the same price as Bitcoin. Like Bitcoin, one of the key things about Bitcoin is there's 21 million of them. There's never going to be more than 21 million Bitcoin, right? There's how many Cardano tokens are there? I actually don't know, but many. Many more than 21 million. And so if a Cardano, if an ADA was $50,000, the total market cap of this thing would be absolutely astronomical. And so the total amount of money it takes, this is how you have to think about it, right? The total amount of money it takes to get the token to that price level is in many cases impossible. It's just not going to happen. So that's how you have to think about it. But the other thing you have to think about, like, it doesn't matter if you own 1 or 100 or a fraction, whatever money you put in, it goes up or down by some percentage. That's what matters, right?
Yeah.
So if you buy a cheap token and it goes up by 10%, then you have 10% more money. If you buy an expensive token and you only have a fraction of it and it doubles in value, then you've doubled your money. It doesn't matter what fraction of it you own, right?
Well, that's the lesson that you learn when you put your first 50 in. Where that 50 goes in, that's your start point. And you don't get that until you do it.
Yeah.
We can sit here and explain it all day, but
you have to do it. Yeah, totally.
You're like,
also, let me at this point say, like, I think that at this point it is irresponsible to not have any exposure to crypto. Right? Honestly, it's like, what are you doing? Do you hate money? Have some exposure to crypto, for crying out loud. And okay, your financial advisor, your boomer financial advisor will probably tell you, oh, well, at this point, even your boomer advisor will tell you, you should have an allocation of like 1% or maybe up to 5%. Up to 5% of your portfolio could be something like Bitcoin. Can I interest you in this, futures-based ETF where you don't actually own Bitcoin? It's like, no. First of all, no. Fire your financial advisor if you have one, and put all your money in Bitcoin. No. And do a 5% allocation or do a 1% allocation. I don't care, but actually buy it. Buy the actual thing. Don't give someone extra fees to give you something that isn't Bitcoin. Like, no, buy the actual thing. And even if that's all you do, if you put 1% of your net worth into Bitcoin right now and you just don't do anything else, over a long enough time period, that's probably going to become like 50% or 90% of your net worth, right?
Yeah.
You might as well do it. Just do it. And if it doesn't work out, if it turns out that I'm some kind of a delusional charlatan, then you're going to lose 1% of your net worth, right? Worse things have happened. I honestly think it's irresponsible to not have any exposure to this right now. And don't be, you you can buy yourself a little bit of exposure and a little bit of insight and experience into this new thing for 50 euros or whatever it is, so that you're no longer simply sidelined and coping. Okay, because look, even if you're, first of all, if you're sure that this is all a scam and it's going to zero, then short it and make money. It's very easy to short Bitcoin. Okay, if you want to bet on the demise of Bitcoin, get rich doing it. But even if you're like skeptical, like put like $50 in, just so that you, and then you can still tell people like me, I told you so. You know, when your $50 goes down to $5, you can still, you know, it's fine. But yeah, I do think that, because there's a lot of things that you only learn when you're actually playing the game.
Yeah.
Even little things. And it's absolutely worth a little bit of money to just get a tiny bit of exposure to start actually experiencing this. Yeah.
Yeah. No, it's, and go slow. And I mean, Jonas and I have both, it's been a couple of months now, and we've both seen, I guess our net worth has gone up. I mean, like it's a tiny little bit, but it has. And that's great. And the only downside that we've experienced, or I'll speak for myself rather, is, well, you did say it, a slight obsession. Yeah. You do kind of, like the chart's going up. It could go up 30% right now while we're talking. And it doesn't really change my bottom line that much because I've got so little in the game. But you still want to know. You're still checking. You're still going.
It's exciting,
and it's exciting. So it's good to start slow and become aware of that like obsession early, and turn it into education rather than just looking at the charts. Like go and learn about the environment. Learn about what some of these things we've spoken about today. If you don't understand what they mean, like understand the stuff. I think that's been equally exciting for me. To sit around in a conversation where literally 3 months ago, this would have all been gibberish to me. Like completely.
Yeah. So this is where we can also, let's talk about risk a little bit, because of course it is risky. And let's be clear, even though I'm generally very bullish on this stuff, I do believe that, like I said, it's the future of everything, et cetera, you know. I also am very risk aware. And you won't hear me complain if I lose everything that I've put into crypto. Like you take a risk, you take a very real risk of loss here. And there's more than one way to lose your money in crypto. But I also think that, and this is something in general, that not just when it comes to money, I just think that the whole approach of trying to bubble wrap the world is not useful. And that is there's always a lot of fuss about, isn't this, it's too risky. Don't do this, it's too risky. It's just like, okay, so you have to do this safe thing. We're buying like 10-year bonds to get 0.1% yield or something like that. Is that safe enough? Oh, actually, some bonds have turned negative too now, so I guess that wasn't safe either. Damn, right? It's like, what is safe enough? And there's almost like this illusion of, well, as long as you do things that worked in the past few decades, it's safe. What if the world changes though? Which it has a lot, right? So a lot of things that looked like the right thing to do, the safe thing to do for a long time, eventually they stop being the right and safe thing to do. And I think there's basically an illusion of safety. And if your goal is to be maximally safe, I basically can't help you. I think that what you should strive to be is to be maximally competent, right? Basically fitness is what I'm talking about, right? It's survival of the fittest. Like, be more capable of surviving in the world, even if the world is not bubble wrapped. So yes, when you get into crypto, you can lose your money. And one of the problems is what you mentioned with obsessiveness. You can get obsessed with this stuff. It can turn into an addiction. You can start experiencing very strong FOMO and start, piling money into stuff. And then it goes down and you panic and you pull out and it goes up again and you go, oh my God, and you put it in again and so on. It can get bad, right? It can get bad.
You can also get caught in bubbles without being aware of it.
Yeah, you can get caught in narrative bubbles and all kinds of stuff.
Yeah.
But But I think that it's one of those things, right? I think what you should strive to do is strive to learn how to handle this. Strive to learn how to discern some, moon boy nonsense, crypto YouTube, right, where everyone's always screaming at you. Like, determine the difference between that and real information.
Yeah. And
learn how to handle this kind of thing. It's like learn how to handle the fear of missing out. Learn how to be disciplined with your money. That's, to me, it's much safer. It is much safer to go through a journey where maybe you lose some money for a while because you make some of these mistakes. Just make sure that you make the mistakes at a price level where you can afford them.
Exactly,
right?
Yeah.
And come out the other end with more knowledge, with more financial literacy, with more discipline about how you use your money. That is much safer in the long term than to just be sidelined because, this is not safe, this is volatile, right? So, yeah, I think people should get over their endless search for safety.
Yeah. Risk is also not always something that you do. We don't see the risk in the things that we don't do.
Yeah.
So what I mean by that is, like, how many people are saving money from their salary? Like, we talk about the save 10% of your salary.
Mm-hmm.
How many people are actually doing that?
Very, very few.
Very few people. That's a higher risk than anything, because that 10% that you're not saving, you're unaware that you're blowing it.
Yeah.
So if you don't save, you've blown all that money. You've lost it. That's like a horrible, that's not even a risk. It's just a loss. It's just a straight up loss.
Yeah, exactly.
But if you saved it and lost it, as you said, there's more value in that.
Yeah, as long as you learn from your mistakes.
Yeah, exactly.
And also, I also want to say, with a lot of narratives that you're going to hear about crypto and risk, and there's a lot of narratives around it, right? It's all a scam. It's bad for the environment. It's this and that and the other. And also, here's, in terms of, this would belong into the truth category of ikario topics. Like, learn to determine the difference between information and simply social consensus narrative. Because if most people who will talk about, let's say, crypto being too risky and maybe real estate or stocks or something being less risky, they're not actually providing you information. They're simply saying the most socially acceptable thing to say about this topic, right? That is the socially safe thing to say. And especially in the circles that person operates in, that is the way that you signal belonging to this circle. It has nothing to do with real risk. And if you're skeptical about what I'm saying right now, it's like, look at how much people worry about you putting money into Bitcoin versus about you getting in your car.
Yeah.
Right? Listen, driving a car is super risky, but it's just generally something we don't talk about it.
Yeah.
Or maybe driving a car is not that great of an example, right? It's not that risky, but it's just like, basically it's a risk that is just, we've completely socially integrated that risk, right? There's absolutely no social repercussion to doing it, even though it has inherent risk. But let's take something like skiing, right? You go skiing. When's the last time someone, gave you some diatribe about how you shouldn't go skiing because it's so risky? Well, guess what? It's really bloody risky. But it's socially acceptable. This is a socially acceptable risk to take. And putting your money into Ethereum is not yet a socially acceptable risk to take. And so learn to determine the difference between someone giving you real information and someone just like signaling tribal belonging, basically.
Maybe a word or two on that. I think like bringing your game up on just like determining why someone is saying what he is saying, and also like the deduction of the information, right? Like I think there's just like some very basic stuff that can be done where basically someone is just like giving you their stream of information, maybe even with some, then it's very obvious like mental leaps in it. But then like the question is, where are the sources provided, right? And if you really want to know what's going on, right, you can look at the sources and the quality of those sources, and then slowly you can start to get an image. And then obviously one has to be careful with confirmation bias, but still like you're getting somewhere. And so.
And that also counts for this conversation here, right? It's like all of the pro crypto stuff I'm saying is I never want to spoon feed someone, what they're supposed to do. So even like, I'm actually fairly reluctant to even make a statement like buy Bitcoin and Ethereum, right? Because actually, I don't want to tell you what to buy. I want you to inform yourself and make your own decisions, right? Because I think that is the real power move, right? The power move is to get to the point where you make your own decisions for your own reasons and your reasoning is strong and you don't need me to tell you anything, right? So really what I'm trying to do with all of this kind of stuff is I'm always trying to or to me, the ideal outcome is that I nudge people towards making those kinds of decisions by themselves, right? And essentially just leveling up their own power. Because I think that's one of the dangers, is to just latch on to some guru. And, because it's all a bit complicated and intimidating and so on. And so instead of making my own decisions about what to do with my money, what if I just listen to someone who seems to know what they're talking about and they're telling me to buy XRP or something like that, right? So, yeah, that's also just, I want to be clear about that. My goal is never to actually tell you what to do with your money. And basically, especially when I make more provocative statements, I'm basically just trying to nudge people into leveling up their own knowledge and doing some of their own research on this. Okay, with that said, let's cover a couple of other topics. So first of all, let's talk about NFTs. What you guys know about NFTs?
So what I know about it is that it's basically